On a quiet afternoon in 2010, a young trader sat in his small apartment, eyes glued to the stock market. His laptop was directly linked to the heart of Wall Street, where the markets were already showing unusual volatility. Little did anyone know, within the next few minutes the financial world was about to witness one of the most chaotic and sudden crashes in history, wiping out $1 trillion in mere minutes. At exactly 2:40 p.m. New York time, this trader logged off, having secured nearly $1 million in profits for the day. But just 60 seconds later, all hell broke loose. The market plummeted nearly 10% in just 4 minutes, a move so violent that traders and analysts were left in complete shock. This was the infamous flash crash of 2010, a moment that exposed the dark side of high-frequency trading and sent regulators scrambling to fix a broken system. But what really caused this crash? And how did a lone trader sitting miles away unknowingly become part of one of the most dramatic financial collapses ever recorded? Suddenly, 75,000 futures contracts, worth a staggering $4.1 billion, were dumped onto the market in an instant. The system was completely shaken. In just 9 minutes, the stock market plunged another 3%, sending shockwaves through Wall Street. By 2:45 p.m., the market was down nearly 10% for the day, one of the most extreme intraday crashes in history. But what happened at the individual stock level was even more shocking. In just 20 minutes, over 2 billion shares changed hands, with a total trading volume of $56 billion. Panic set in as stocks started trading at completely irrational prices, some 60% higher or lower than just moments before. Insanity unfolded in real time. Accenture, a $30 billion company, collapsed from $40 per share to just 1 cent. Yes, 1 cent, in just 7 seconds. Meanwhile, Apple's stock skyrocketed from $250 to an absurd $100,000 per share, briefly valuing the company at $54 trillion, which is almost the entire value of the US stock market today. To put this in perspective, 2 trades for 8,895 Apple shares happened at these insane prices. Normally, the total sale would be worth $216,000, but instead, they sold for $89.5 million. And then, as suddenly as it began, it stopped. By 3 p.m., the market had miraculously recovered most of its losses, but the damage had been done. The entire flash crash lasted just 36 minutes, yet it exposed fundamental weaknesses in the system that no one had anticipated. Naturally, this unprecedented event raised some serious questions. What caused this crash? Who were the traders behind it? And how does all of this connect to a British man who discovered a loophole that allowed him to make millions from his bedroom?
Meet Navinder Sarao. Born in 1978 into a working-class British family, Sarao's introduction to the stock market came through a job at Futex Live in the mid-2000s. It was there that he mastered the art of futures trading, a type of contract that allows traders to bet on market movements without ever owning the actual stocks. And as it turns out, he was very, very good at it. But how did one man sitting alone in his bedroom end up shaking the entire financial world? The stock market is a dynamic entity, but there are moments in history when it experiences sudden, inexplicable crashes. One such event was the infamous flash crash of May 6, 2010. The catalyst for this dramatic market drop? A single trader operating from his bedroom thousands of miles away. The impact of the flash crash. At precisely 2:32 p.m. Eastern Time, the market was hit with an enormous shock. A staggering 75,000 E-mini S&P 500 futures contracts, valued at $4.1 billion, were suddenly sold into the market. Within a mere 9 minutes, the stock market plummeted by 3%, triggering widespread panic. By 2:45 p.m., the market was nearly 10% down for the day. The chaos at an individual stock level was even more alarming. Between 2:40 and 3 p.m., over 2 billion shares changed hands, amounting to a staggering $56 billion in total volume. Amidst this turmoil, irrational pricing took over. Some stocks saw their values drop by more than 60%, while others surged to astronomical, unrealistic heights. For instance, shares of Accenture, ACN, plunged from $40 per share to just 1 cent within seconds, effectively reducing a $30 billion company to a valuation of under $10 million. Conversely, Apple's stock skyrocketed from $250 to an insane $100,000 per share. temporarily giving the company a ludicrous valuation of $54 trillion, almost equal to the entire US stock market's worth today. By 3 p.m., the market had mostly recovered from this wild ride, but the damage had been done. The entire event had transpired in just 36 minutes, cementing the name flash crash in financial history. This left experts and regulators scrambling to answer pressing questions. What triggered this crash? Who was behind it? And how did a lone British trader manipulate the system from his bedroom? Enter Navinder Sarao, the man behind the chaos. Navinder Sarao had an unremarkable early life, but showed a natural talent for trading. His big break came when he joined Futex Live, a proprietary trading firm in the mid-2000s, where he honed his skills in futures trading. He specialized in E-mini S and P500 futures, a financial instrument that allowed him to make leveraged bets on the stock market's movements. By 2008, Sarao had amassed around $2 million in personal wealth. The timing was crucial, as the world was in the middle of a global financial crisis. Sensing that governments would bail out financial institutions, he bet all his money on a stock market rebound.
However, by 2009, Sarao found that making profits was becoming increasingly difficult. A new player had entered the game: high-frequency trading. These powerful, algorithmic trading programs executed millions of trades per second, exploiting minuscule price differences across different exchanges. This technological evolution made it nearly impossible for individual traders like Sarao to compete. The rise of high-frequency trading. In July 2009, the New York Times published a piece highlighting how HFT firms were using advanced strategies to gain an unfair advantage. One such method was flash orders, where certain traders were granted access to incoming orders milliseconds before the rest of the market. This allowed them to buy stocks at a lower price and sell them at a higher price instantly, effectively making risk-free profits. Another common strategy was spoofing, an illegal market manipulation technique. Traders would flood the market with fake orders to create the illusion of high demand or supply, tricking other investors into moving prices in a favorable direction. Once the price moved, the spoofers would cancel their fake orders and execute real trades for profit. Frustrated by these manipulative tactics, Sarao built his own high-frequency trading bot. He programmed it to place thousands of fake orders, a technique known as layering, to mislead the market into thinking there was significant buying or selling pressure. This artificial momentum allowed him to profit massively from short-term price fluctuations. His bot was incredibly effective, sometimes making him hundreds of thousands of dollars per day. On the day of the flash crash, Sarao was trading from his parents' home in Hounslow, London. By midday, his bot was placing $200 million worth of trades, and by 2:40 p.m., just a minute before the crash began, he logged off after netting $950,000 in profits. The true cause of the flash crash. While Sarao's actions contributed to market instability, he alone didn't cause the crash. The actual trigger was traced back to a large mutual fund, which placed an enormous order to sell 75,000 E-mini S and P500 contracts valued at $4.1 billion. The mistake? Instead of executing the trade gradually over several hours, their algorithm decided to sell 9% of the total trading volume every minute without a price limit. This decision backfired due to the presence of high-frequency trading bots, which accounted for 33% of the trading volume at that time. These bots weren't genuine buyers but were simply rapidly trading amongst themselves, artificially inflating the volume. As the algorithm interpreted this fake volume as real liquidity, it sped up the selling process, overwhelming the market and leading to a massive price collapse. The domino effect caused individual stocks to experience extreme price swings, eventually triggering a market-wide panic. The aftermath, investigation, and arrest. The Commodity Futures Trading Commission (CFTC) noticed unusual trading activity during the crash. Upon closer inspection, they discovered that Sarao's orders accounted for up to 20% of all sell orders at certain points during the day. While he didn't trigger the crash, his actions certainly exacerbated market instability. Years of investigation followed, and in 2015, Sarao was arrested in the UK. He was charged with 22 counts of wire fraud, commodities fraud, and market manipulation, carrying a maximum sentence of 380 years in prison. The U.S. Department of Justice claimed he had made at least $12.8 million from illegal activities between 2009 and 2014. However, in a surprising turn of events, Sarao cooperated with authorities, helping them improve financial market regulations. As a result, he received a reduced sentence of just 1 year under house arrest. Lessons from the flash crash. The flash crash exposed critical flaws in modern financial markets. Algorithmic trading risks. Large automated trades can cause extreme volatility. High-frequency trading manipulation. High-frequency trading doesn't always add market liquidity, sometimes it just creates artificial volume. Regulatory gaps. Before 2010, spoofing wasn't explicitly illegal in U.S. markets. The crash led to the Dodd-Frank Act, which formally outlawed spoofing and layering. Despite these changes, market manipulation still exists. Many believe that Sarao was made a scapegoat, as large Wall Street firms have engaged in similar tactics for years without repercussions. The story of the flash crash is a reminder that while technology has transformed trading, it has also introduced new risks and vulnerabilities. And sometimes a lone trader in a London bedroom can shake up the entire financial world. If you enjoyed this deep dive into financial history, don't forget to subscribe and check out our other videos for more market insights.